Chapter 8 is Peter Lynch's checklist for the near-perfect stock, the kind of business you dream of finding. Lynch's central idea is simple. The easier the business is to understand, the better your chances of spotting a winner early and holding on as the rest of the market slowly wakes up. He starts with a useful rule of thumb. If you can get the story just by living your life, by shopping at the mall, visiting restaurants, or watching how people use a product, you've got an advantage. Lynch prefers a plain, simple business to a glamorous, complicated one. If you hear someone say, "Any idiot could run this business," that's often a compliment. Simplicity makes a company easy to follow, reduces surprises, and keeps the big institutional investors away until the gains are already well underway. Lynch then lists 13 attributes that, when many of them appear together, describe an ideal investment. I'll walk through each one and add what to look for when you do your homework. 1. The name sounds dull or even ridiculous. Companies with boring names or goofy names often fly under Wall Street's radar. That gives early buyers time to accumulate before analysts and institutions discover the story. 2. The company does something boring. Businesses that manufacture bottle caps, process coupons, or rent cars to people while their cars are repaired may not make headlines, but they can make steady profits for years. 3. The company does something disagreeable. Waste recycling, grease removal, or cleaning up messes is unglamorous but durable. People and companies pay for services they find disgusting because somebody has to do them, and the business model tends to be repeatable. 4. It's a spin-off. Divisions carved out of larger companies often get overlooked and are handed strong balance sheets and focused management. Spin-offs frequently start life underappreciated, and when they prove themselves, they can leap higher quickly. 5. Institutions do not own it, and analysts do not follow it. Lack of institutional ownership is often a sign that the story has not been priced in. If nobody is covering the stock, the market can take longer to notice, which is exactly what you want when you're an early buyer. 6. Rumors abound that it is tied up with toxic waste or worse. Oddly, stigma can be an advantage. When an industry makes respectable investors squeamish, patient amateurs who understand the fundamentals may scoop up the shares. 7. There is something depressing about it. Funeral homes, cemeteries, and other grim but steady businesses are examples. Demand does not disappear, and certain services are recession-resistant. If the business grows by acquiring mom-and-pop operators and can sell pre-need plans that generate cash today, the economics can be powerful. 8. It is in a no-growth industry. Lynch prefers boring, slow-growth industries when those industries are consolidating or when a smart operator can take market share. With little excitement comes little competition, and that is fertile ground for above-average returns. 9. It has a niche or franchise, a local rock pit, a newspaper that dominates its city, or a patented drug, are all examples. Niches create barriers to competition and allow pricing power. Once a company controls a franchise, it can often raise prices to a profitable level without losing customers. 10. People have to keep buying it. Consumables, razor blades, cigarettes, soft drinks, and pharmaceuticals that require repeat purchases create predictable revenue streams. A one-hit novelty toy is far less attractive than a staple people replace month after month. 11. It is a user of technology rather than a maker of cutthroat tech. When technology drives down costs for a customer, the customer can win. Lynch would rather buy the supermarket that uses automatic scanners than the firm that makes the scanners, because the supermarket benefits from cheaper equipment and can boost margins. 12. The insiders are buying. When employees and officers are net buyers, that is a strong vote of confidence. Insider buying is now meaningful when it includes lower-level employees as well as executives. It suggests people who know the business believe the stock is undervalued. 13. The company is buying back its own shares. Share repurchases reduce the number of outstanding shares, which can dramatically increase earnings per share if total earnings hold steady. A repurchase program is one of the simplest and most shareholder-friendly uses of cash when the management believes the stock is cheap. Lynch illustrates these attributes with real examples. He praises automatic data processing as a quietly wonderful company whose customers and employees would have noticed long before analysts did. He points to companies such as Safety Clean and Waste Management because they do disagreeable things that keep competitors away, and to Service Corporation International for its funeral home business and the clever pre-need insurance that generates cash up front. He highlights spin-offs and the so-called baby bell companies after the breakup of the old telephone monopoly as classic opportunities where ownership was reorganized and hidden profits were realized. Two practical themes run through the chapter. First, Use your everyday life as research. See what businesses are busy, what products are selling out in the supermarket. That is your amateur edge. Second, do the arithmetic. If a product seems popular, find out how much it actually contributes to the company's sales and profits. A fad that is a rounding error at a giant company will not move the needle. Remember this practical takeaway. Keep your ears and eyes open in daily life. Prefer simple businesses you can understand, pay attention when insiders buy, and when management repurchases shares. And most of all, translate the simple observation that people keep buying this into numbers that show the earning power and durability of the business. That's how ordinary investors find extraordinary returns.